Markets are officially open for trade. Joining me now is Kevin Mon, president at Hennion and Walsh. Kevin, welcome to the New York Stock Exchange.
Thank you, Ashley.
So, investors are betting on a rate cut in September.
Yes.
You say that this should have happened in June. Tell me more about that.
Absolutely. If the Fed is indeed data dependent, looking at their own projections that came out of that meeting in June, they were forecasting unemployment to increase to 4.5% this year and stay at 4.5% all the way through the end of next year. They also updated their forecast for economic growth, believing that was going to slow to 1.4% this year and stay below 2% for the better part of the next 2 years. So if they believe unemployment's rising, economic growth is slowing, that would suggest that a rate cut should have been under consideration back in June. Of course, they're still worried about tariffs and the potential inflationary impact of tariffs, which is why they raised their inflation forecast to 3.1%. I think that's misguided. I think we're starting to see dents now in the labor market, and in all likelihood, we'll see that first 25 basis point cut in September.
What is the biggest challenge for the Fed right now when it comes to managing their dual mandate?
Yeah, obviously, one, it's become very political, and we've seen multiple scenarios play out on the political front. But two, the unknown nature of where tariffs are going to end up and what ultimately these trade agreements will entail. I still contend that those tariffs pose more of a growth scare than they do an inflation scare, but the Fed isn't sure. So if they're right and some of these tariffs do present inflationary pressures, then we're in a stagflation type of scenario. Higher unemployment, lower growth, higher inflation, that's what they want to try and avoid. But I still think there's more of a threat of recession than there is stagflation right now, and the Fed should be cutting.
The Fed's preferred inflation gauge, PCE data, is going to be released on Friday. What are you anticipating?
More of the same. I think we're going to see it well above their 2% target, but still well below what we saw going back during the COVID era in terms of all the inflationary pressures that were put with the inflow of money that took place in the economy. We're on the right track with respect to inflation, but we still need to figure out how much of an impact these new tariffs are going to have, and I still believe it's going to be a mooted impact. So my fear is that that inflation number comes in hot, well into the 3% level, and then the markets are going to take a pause and say, well, wait a second, maybe a rate cut in September isn't on the table anymore. But if it comes in line with expectations, I believe that there's still going to be a high likelihood of a rate cut, and that's good for the markets because the markets are already pricing it in.
Markets have rallied since all of that volatility that we saw in April, but do you think there's a chance that that volatility will return?
Yeah, it's a great question. So we've seen a 69% decline in the VIX over the last 20 weeks. That's the sharpest volatility crash on record, basically going back to the initial tariffs tantrum. We've seen 19 record highs for the stock market this year, on top of the 57 record highs last year. We now have the S&P 500 trading at a PE of roughly 25.5. This can't go on forever. All 11 GIC sectors are positive for the year. At some point in time, there's going to be more short-term bouts of volatility. But that volatility could create opportunities and attractive entry points. So investors should brace themselves for some more volatility ahead and anticipate where the opportunities will exist going forward, both from a growth and an income perspective, because they're still out there, Ashley.
And those opportunities, where do you think the best opportunities for investment are, and where do you think investors should be focusing on?
Sure. I've been doing this 32 years now, and I've always followed the golden rule of follow the money. So where is all the money being spent right now? In two places that I see, one on AI infrastructure buildouts and two on aerospace and defense. If you look at AI infrastructure buildouts, you look at those data centers, you look at the cooling solution for those data centers, and then you look at the utilities that supply all the power to those data centers and some of the offshoots of that with some of these energy companies that are building small modular reactors to help supply power to these data centers off-grid. Then how about aerospace and defense? We just heard 2 weeks ago, maybe it's 3 weeks ago now, that NATO countries committed to spend up to 5% of their respective GDPs on defense by 2035. The European Union committed to spend the equivalent of 840 billion US dollars on their own defense needs through the next 3 years. Who's going to benefit from all that spending? Well, likely the largest defense contractors in the world, whether it's BAE System over in Europe or it's companies such as Northrop Grumman, RTX, or even Lockheed Martin here in the US. There are still opportunities for growth ahead if you follow the money.
NVIDIA is going to be releasing its earnings Wednesday afternoon. What are you going to be looking out for, listening for?
Yeah, as NVIDIA goes, so goes the stock market. It's the most followed stock on Wall Street, and technology is the most held sector amongst retail investors, so it matters. Right now, we're looking at EPS consensus estimates between $1 and $1.01. I think NVIDIA knocks the cover off the ball once again, exceeds expectations for earnings and for revenues. But what I'm really keenly interested in is where is the growth coming from? Last quarter, it came from data centers more so than chips. Do we get more of an even balance this quarter? I still think we see more growth on the data center side.
All right, Kevin Mon, president at Henion and Walsh, thank you so much for joining us at the New York Stock Exchange.
Thank you for having me.
Labor Day.